Is your portfolio ready for another 2008, 2009 bear market? If not, watch this video. You see, one of the things that I want to do is I want to make sure that you understand that there is a problem. And the problem is that we've been in a very long bull market. And bull markets can give us amnesia. Did you know you had amnesia? Most people who have amnesia don't. What do I mean by that? Well, I'm being a little facetious, but ultimately there is such a thing as market amnesia, where we forget just how volatile the market can be. We seem to reach new highs every day, and that can lull us to sleep, and like a siren song for sailors approaching dangerous reefs, we got to be careful. 2008, there's a problem out there, and that is that bear markets tend to happen again. History doesn't repeat itself, but it often rhymes. You know, there's two blogs that I want you to take a look at on our website. If you go to bravadowealth.com/blog, you can find one by my colleague Jared Coffin, and you can find one by myself. One is called Rules-Based Investing that I wrote, and another one that he wrote is called Buy and Hold is More Difficult Than You Think. So here's the deal. There's a problem, and the way I handle it is a little bit different perhaps than you've heard before. You see, the modern portfolio theory is that we know that large caps, medium caps, and small caps will react with a certain amount of volatility in different market cycles, right? And so we say to ourselves, well, as I approach that fragile decade, I'll simply get more conservative. Now hold on a second here. What's the fragile decade? The fragile decade is 5 years before and 5 years after you start taking income. I call that the fragile decade because in that decade we have to be very careful not to experience another 2008, 2009 or a 2001 to 2003. Bear markets in the beginning of your income phase can be highly detrimental to your retirement income, to your longevity risk. What I'm trying to say is if your first years are your worst years, you could run out of money. And we've got another blog on that. The sequence of returns risk, we call it the dangerous descent into retirement. That's a blog that I wrote. You got to read it. Charts, graphs. It'll help you understand the problem. The problem that, quite frankly, I'm afraid too many people have forgotten about because it's been so long since we've had a good, honest bear market like 2008, 2009. So what does it mean? What it means is we had to find a solution. And let me share with you one of the ways that we help to diversify you and help you to prepare for 2008 and 2009. As I was mentioning, modern portfolio theory says to us that large caps, medium cap stocks, small caps, bonds of different types all have volatility expectations. And because of those volatility expectations, all we have to do is take you from small cap, which are small companies that are very volatile, to large cap stocks, which, stocks like, say, blue chips, things that you buy every day, companies that you've heard of before. These larger cap stocks, in theory, are going to have low volatility, and they're going to help you to and especially if they pay dividends, they're going to help you to have a smoother ride in retirement. Okay? Sounds good in theory so far. But then also, too, we take a look at bonds. And with bonds, they diversify you away from some of the risks that you can experience and the volatility that you can experience with stocks, with equities of all types. Now, there's lots of different types of bonds. I won't go into it, but bonds typically and theoretically move in a different manner and the opposite of stocks. If stocks are going up, no one wants bonds. And if bonds are going up, well, they're a better deal perhaps than stocks. And so that creates a smoothing factor to the volatility and to the performance of your portfolio. That is how it usually works. And there is truth to it, don't get me wrong. However, modern portfolio theory has lent itself to a lot of folks over the last 10, 12 years looking at indexing as the answer. You simply just buy a stock index of large cap stocks or medium mid cap stocks, and you buy an index of bonds, and then you just set it and forget it. Kind of reminds me of a late night infomercial. There was a Ronco grill that you would set it, and then the audience would chime in and forget it. Well, I would say that your retirement is more important and more complicated than a late night infomercial grill. right? In fact, where are those grills today? Good question. So let me give you an analogy. I live here in beautiful Central Florida. I say beautiful, it hasn't been great lately. It's been a hot summer, and every day, between 1 to 4 p.m., we get thunderstorms, and these thunderstorms are torrential. The water gets picked up in the Gulf of Mexico. For some reason, it travels over Tampa and comes to us, and it just dumps all this water on us, right? So when I'm driving down a major interstate and it's a Sunday afternoon, a Sunday morning, and there is nobody awake. It's just me and the open road, and the speed limit is 70 miles an hour. Okay, there are parts of Interstate 4 between here and Tampa that are 70 miles an hour. How fast do I drive? Well, I don't know if the police are listening, but sometimes I go slightly faster, let's just say, theoretically, than 70 miles an hour. I put it on cruise control, and I'm going 79 miles an hour. I mean, it's my car can easily do that, and 79 kind of puts me in a place where I'm thinking if I do get a ticket, it won't be that bad, but it's safe. 70, and I'm getting passed, by the way, just so you know. People are passing me on the road. Well, if I'm driving down that same road and it's bumper to bumper and a big thunderstorm comes in, what do? I slow down. Well, the way we should invest our funds and the way we should invest your funds is to have strategies that have a risk on and a risk off setting, using indicators, technical indicators that let us know, hey, this is great weather. This is a fantastic time for us to go full speed ahead within reason. Now, obviously, if your risk tolerance is on the lower side, we don't put 100% of everything you have into the fastest assets, the highest risk assets, but we do tilt towards going faster. We put our cruise control on 79, so to speak. But if you're a conservative person and it's a beautiful, non-volatile stock market, bright sunny skies, no police officers out there. Secondarily, or the contrary to that, if you're a young, aggressive investor, but it's 2008 and 2009, it doesn't matter how aggressive you say you are, losing money to volatility, experiencing the downside hurts you, especially if you are in that fragile decade. And so what we do is we use indicators, and I'd love to be able to explain that to you. What you can do is you can click the link below, you can schedule a quick conversation, but you can also send us an email, and we'll send you some videos that we've put together explaining how we manage money so that we can help you avoid and help you navigate the next 2008. Thank you so much.